Most people think investing is some complicated game reserved for Wall Street professionals wearing expensive suits and staring at giant computer screens all day. That belief alone stops millions of normal people from ever building wealth in the first place. Social media makes investing look even more confusing. People brag about turning a few $100s into millions overnight while promoting risky trades that look more like gambling than investing. Broke Ben watches these videos constantly and thinks investing only works if you get lucky. He believes normal people cannot compete because he assumes rich investors know secret tricks. Budget Ben sees investing differently. He understands building wealth usually comes from consistency, patience, and avoiding unnecessary mistakes. Baller Ben already knows the real secret sounds boring. Wealth is often built through simple systems repeated for years instead of flashy overnight wins. The truth is that investing does not need to be complicated at all. Most successful long-term investors follow a handful of basic principles extremely well. This video breaks investing down into 4 beginner-friendly steps anyone can understand. No confusing jargon, no day trading hype, and no fake millionaire promises. The goal is not becoming rich tomorrow morning. The goal is building a system that quietly grows stronger year after year. Most beginners immediately ask what stocks they should buy first. But surprisingly, buying investments is not actually the first step. The first real step happens before investing even begins. It starts with protecting yourself financially from life's unexpected problems. Broke Ben ignores this completely. Every dollar he earns immediately disappears into clothes, restaurants, subscriptions, and random impulse purchases. When emergencies happen, Broke Ben panics instantly because he has no backup plan. A single unexpected expense can completely destroy his finances overnight. Budget Ben handles money differently. Before investing anything, he focuses on building a basic emergency fund first. An emergency fund is simply money saved in a safe account for unexpected situations. It creates breathing room when life inevitably throws problems your way. Baller Ben understands emergency funds are not exciting, but they are powerful. Financial stability gives him the ability to make smart decisions instead of emotional ones. Imagine investing $1,000 into the stock market. Then, suddenly your car breaks down and repairs cost $800. If the market happens to be down at that exact moment, you might be forced to sell investments at a loss just to survive. That single emergency could erase months or years of progress. This is why having even 1 month of basic expenses saved matters so much. The emergency fund protects your investments from life's small disasters. Broke Ben thinks emergency savings are pointless because he assumes he can always use a credit card later. Unfortunately, that mindset creates even bigger financial problems. High-interest debt quietly destroys wealth faster than most people realize. Many credit cards charge between 15 and 25% interest every single year. Broke Ben carries massive credit card balances while trying to invest at the same time. He proudly buys stocks while losing huge amounts of money to interest charges every month. Mathematically, this makes almost no sense. Earning roughly 10% annually in the market while paying 20% interest guarantees you are falling behind. Budget Ben understands paying off high-interest debt is actually a form of investing itself. Eliminating 20% interest creates a guaranteed return with zero risk. Baller Ben thinks about debt strategically instead of emotionally. He understands not all debt is equally dangerous. For example, low-interest debt like a 4% mortgage is very different from a 20% credit card. Long-term investment returns can reasonably outperform lower interest rates over time. The general rule is simple. If debt interest rates climb above roughly 15%, aggressively paying it off usually becomes the smartest financial move. Debt below that level becomes more flexible depending on personal risk tolerance and financial goals. But extremely high-interest debt should never be ignored. Once emergency savings exist and toxic debt is under control, beginners finally reach the investing stage. This is where most people suddenly become overwhelmed again. Broke Ben immediately downloads a trading app and searches for trending stocks online. He buys companies he barely understands because strangers on social media sounded confident. Budget Ben realizes something important first. Before buying investments, he needs to choose the correct account type. Most beginners completely overlook this step, but choosing the wrong account can quietly cost thousands of dollars in taxes over time. Baller Ben pays close attention to taxes because he knows keeping more money matters just as much as earning more money. Smart investors optimize both growth and efficiency. One of the most powerful beginner investment accounts is called a Roth IRA. It allows investments to grow completely tax-free over decades. With a Roth IRA, you contribute money that has already been taxed. But later, when the investments grow massively, you owe zero taxes on those gains during retirement. Imagine investing $1,000 that eventually grows into $50,000 over several decades. In a Roth IRA, all those gains could potentially be withdrawn tax-free. That single advantage can save investors enormous amounts of money over their lifetime. Yet many people never even learn these accounts exist. The downside is that Roth IRA money is designed for retirement. Taking gains out too early can trigger penalties and taxes. Ben likes the Roth IRA because it encourages long-term thinking. The restrictions help prevent emotional decisions and impulsive withdrawals. Baller Ben often uses multiple accounts depending on his goals. He understands flexibility and tax advantages both have important roles. A normal taxable brokerage account offers complete freedom and flexibility. Money can be invested or withdrawn anytime without retirement restrictions. However, taxable accounts create capital gains taxes whenever investments are sold for profits. Over decades, those taxes can reduce overall growth significantly. The key lesson is that where you invest matters almost as much as what you invest in. Smart structure creates long-term advantages. Now comes the question every beginner asks. What should you actually buy once the account is ready? Broke Ben immediately searches for the next hot stock everyone is hyping online. He thinks finding one lucky winner is the fastest path to becoming rich. The problem is that predicting winning stocks consistently is incredibly difficult. Even professional investors regularly fail to beat the market long-term. Budget Ben avoids chasing trends completely. Instead, he focuses on broad index funds that own thousands of companies at once. An index fund allows investors to buy tiny ownership pieces of massive groups of businesses simultaneously. Instead of betting on one company, you own a small part of entire markets. Baller Ben loves index funds because they remove unnecessary guessing. He does not need to predict which company becomes the next giant success story. A simple 3-fund portfolio is one of the most popular beginner investing strategies in the world. It is simple, diversified, and historically extremely effective. The largest portion usually goes into a total U.S. stock market or S&P 500 index fund. This provides exposure to many of America's largest and most successful businesses. Another portion often goes into international index funds. This creates diversification beyond the United States and spreads risk across global markets. Some investors also include a smaller percentage of bonds for stability. Bonds usually grow slower than stocks, but often reduce overall volatility. The powerful part is that this strategy requires very little maintenance. Instead of constantly trading, investors simply continue contributing consistently. Research repeatedly shows index funds outperform most actively managed funds over long periods. Lower fees and less unnecessary trading create huge advantages over time. Meanwhile, day trading destroys many beginners financially. Trying to predict short-term stock movements often turns investing into emotional gambling. Broke Ben refreshes stock prices every few minutes and panics whenever markets drop. His emotions constantly control his decisions. Budget Ben ignores daily market noise almost entirely. He understands short-term volatility is normal and focuses on long-term growth instead. Baller Ben automates his investments completely. Every month, money gets invested automatically, whether markets are crashing or booming. This strategy is called dollar-cost averaging. It removes emotions from investing and builds wealth through small, repeated actions over many years. In the end, the first $1,000 matters far less than the habits created along the way. Broke Ben chases shortcuts, Budget Ben builds consistency, and Baller Ben builds systems that quietly create freedom for decades. I hope you enjoyed learning a little bit about how 3 different versions of myself get started on their investing journey. Remember that you have the majority control over your emotions and decisions when it comes to your finances. Subscribe for more helpful money tips from the Money Faces of Ben.